You would set up an SPV with the aim that the SPV buys the shares in the business that you're purchasing. So if you're purchasing Smith's Sons electrical contractors, you would set up an SPV, call it SPV Holding Company 1, and it would buy the shares of the business that you're purchasing. I'm actually going to deviate a little bit, but it sort of explains the main reason why people use SPVs.
Can you tell a story?
I am working on an acquisition at the moment. I'm acting for the seller. And we had the SPA through, which is the share purchase agreement, and it had the buyer and the seller listed at the top. And I clocked that the buyer was a personal person. It was the individual, not a limited company.
Yeah.
And there's some deferred consideration with this deal, which is why I flagged it. Normally I would say it's up to the buyer to get their own tax advice.
What's deferred consideration?
When somebody isn't paying the full purchase price up front, they're paying it over 3 years.
Okay, so the business needs to remain trading,
solvent,
to give
exactly.
purchase back to the vendor.
And the reason why I raised this is because there was quite a considerable amount of deferred consideration, and I raised it because the person buying the shares personally, they essentially have to use their own personal money to buy those shares.
Okay.
So where that money comes from could be anything. It could be mortgages, it could be loans, it could be friends and family. But most likely, they're going to need to take dividend or salary out of the business, pay tax on it, and then use post-tax income to pay the seller.